Fraud is a word that sends shivers down the spine of any business owner. It's like a ghost lurking in the shadows, waiting for the right moment to strike. And while many organizations have internal procedures and checks in place to combat fraud, there's a nagging question that often goes unaddressed. What if those checks miss something? What if they trigger an alert that gets overlooked? These are the questions that keep accountants awake at night, and they're not unfounded. Imagine this: you're running a business, and you've got a mountain of invoices piling up on your desk. You rely on your team to follow standard procedures, to check and double check everything. But what happens when the checks and balances fail? A small oversight here, a miscommunication there, and suddenly you're faced with a discrepancy that could cost you thousands. This is where three-way matching comes into play, a powerful tool that can help you combat fraud before it even has a chance to rear its ugly head. So, what exactly is three-way matching? It's a process that compares three essential data sets: the purchase order, the receiving report, and the invoice. Think of it as a safety net that catches potential errors or fraudulent activities before they slip through the cracks. When a company orders goods or services, it starts with a purchase order, a document that outlines what's being bought and at what price. When the goods arrive, a receiving report is created to confirm that the items received match what was ordered. Finally, the vendor sends an invoice requesting payment. By comparing these three documents, businesses can quickly identify discrepancies and take appropriate action. Let's break it down a bit further. Picture this scenario: you order office supplies for your team. You've got a purchase order that specifies the items and quantities. When the delivery arrives, your team completes a receiving report to confirm that everything is in order. But then, the invoice comes in and something doesn't match up. Maybe you were charged for an extra ream of paper, or perhaps the price per item is higher than what was agreed upon. This is where the magic of three-way matching happens. Instead of just paying the invoice and hoping for the best, you can dig deeper, cross-reference the documents, and address the discrepancy before any money changes hands. Now, you might be wondering why this process is so crucial. Well, let's consider the role of accountants in this process. Accountants are the gatekeepers of financial integrity in any organization. They're the ones who ensure that every purchase is authorized, that invoices are legitimate, and that all financial data is accurate. In a three-way match scenario, accountants review and validate the purchase order, the receiving report, and the invoice to ensure they all align. If there's a mismatch, they're the ones who will roll up their sleeves and investigate further, working with vendors to resolve any issues. But it's not just about catching errors, it's also about preventing fraud. By implementing a three-way matching process, businesses can avoid unauthorized purchases and ensure that they're only paying for goods and services that were actually received. This level of scrutiny can save companies from significant financial losses and help maintain the trust of stakeholders. Let's look at a few examples to illustrate how three-way matching works in practice. Say a company orders a new piece of equipment. They receive a purchase order confirmation from the vendor, a delivery note when the equipment arrives, and an invoice requesting payment. The accountant will match these three documents to ensure that the correct equipment was received, that it's in good condition, and that the invoice reflects the agreed upon price. If anything looks off, they can take action before any payment is made. Or consider a company purchasing raw materials. They place an order, receive the materials, and then get an invoice. By matching the purchase order, receiving report, and invoice, the accountant can confirm that the correct quantity of materials was received and that the pricing aligns with what was agreed upon. If discrepancies arise, they can address them immediately, preventing potential overpayments. The importance of three-way matching extends beyond just fraud prevention. It also helps with cost control. By validating that goods or services were received and that invoices match the purchase order and receiving report, businesses can identify discrepancies before they result in overpayments. This level of diligence can lead to significant savings over time. Moreover, the three-way matching process fosters transparency in financial reporting. Accurate and up-to-date financial data is essential for making informed business decisions. When discrepancies are caught and resolved early, it ensures that financial records remain accurate, providing a clear picture of the company's financial health. Compliance is another critical aspect of three-way matching. For publicly traded companies, adhering to financial policies, external regulations, and accounting standards is paramount. Non-compliance can lead to serious penalties and fines, which is something no business wants to face. By implementing a robust three-way matching process, companies can ensure that their payments are compliant and that they're operating within the law. Finally, let's talk about efficiency. The three-way matching process streamlines the accounts payable workflow. By catching errors before payments are made and having all the right documentation in place, businesses can reduce the risk of delays in processing payments. This efficiency not only saves time but also helps maintain strong relationships with vendors, ensuring that they're paid on time and in full. In conclusion, the three-way match process for accounts payable is more than just a procedure, it's a smart way to do business. It's a proactive approach that helps companies improve the accuracy, and efficiency of their accounts payable processes while protecting against fraud and maintaining compliance with regulations. By comparing the purchase order, receiving report, and invoice, businesses can prevent unauthorized purchases, identify discrepancies, and ensure timely payments. Accountants play a crucial role in this process, acting as the guardians of financial integrity. By embracing three-way matching, companies can effectively manage their accounts payable and safeguard their bottom line. In a world where fraud can strike at any moment, having a solid system in place is not just a smart move, it's essential for the long-term success of any organization. So, if you're not already using three-way matching, it might be time to consider it. After all, a little prevention goes a long way in protecting your business from potential pitfalls.